Good evening. This is Ken Long from Tortoise Capital Management with a review of the weekend reports for March 26, 2011. We have a market that's in bullish volatile conditions. It's at 64 on an annual basis, looking at weekly RSI, so slightly above the halfway point. On a 10-day basis, using the 10-day index, it's at 92, so slightly overbought. The 200-day moving average percent stretch is at 11.09%, which is bullish, but still in white condition, so it's been better. The slope of the 50-day moving average has improved to 0.26%, but that's still in the red zone for the slope compared to the last 180 days, so that's slightly bearish. ADX is at 24.3, which is neutral. Not as bearish as it has been earlier in the week. The ATR percentage has dropped down to 1.46%. Still has it in volatile conditions, but improving. All the equity regions remain weak this week. Asia's lagging except for South Korea and India. Silver has continued to do well, although it's starting to look a little toppy once more. The monthly and quarterly rebalancing, no change until about the 1st of April. In ETF2, the theoretical exposure improves to 10%. The model portfolio is at 40%. The only thing we do this week is update our stops in energy and silver. Looking at the market health check, we're looking back 10, 20, and 30 days, the vertical blue lines. The horizontal purple line is the swing high. It's still at 135 from almost 3 weeks ago. The two red lines represent a 5% pullback from that swing high and then a 10% pullback. That first 5% is in the range we would consider to be random noise. Between 5 and 10% is an ordinary correction inside a bull market. And you can see that we got down to that level 2 weeks ago and have been climbing ever since. Green line is the 10-day moving average. Red line is the 50-day moving average. You can see right now price is better than the 50. The 50 is better than the 10, but which has started to roll back up. The 200-day moving average is off the chart yet, and we're 11% above that. ADX, you can see, has dipped back under 25. We still have minus DI greater than plus DI, so the trend right now is still negative, but you can see plus DI improving, what with the buying action of the last week. On a 10-day basis, Williams percent R, you can see we're overbought, and on an annual basis, we are also overbought. So this is a market that looks like it's trying to shrug off this selling and has bounced off this pullback to the boundary of a 10% pullback. It closed Friday in a doji, so it remains to be seen if this is a point of further failure or not. The technicians would be looking at a series of three lower highs if this doji turns out to be a swing high. If it fails through the 50 and then through the 10, a retest of 125 would be natural. Really, the first support level I see is at about 129.5, where it found support earlier in this week. Summary of the ETF2 database. 1 out of the 10 regional indexes, that's emerging markets, are positive on a 5-week rate of return. Everything else is negative. And that's what brings us to 10% invested, 90% cash. SPY at 43 is better than EFA, which is the global rest of the world, at 37. Inside the U.S., the mid caps are the best, followed by the small caps, followed by the large caps, followed by technology. Euro-Asia, which is EFA, and EWJ Japan are the weakest regions. Small caps in the U.S. and mid caps are the strongest of the 10 global sectors. Looking at the world market model, you can see that commodities are still dominating, as is the energy sector. Finance is lagging both in the U.S. and globally. Japan just it crushed because of the disaster there. You see, Asia is starting to separate into winners and losers here. You see South Korea and India have made quite a bounce, and this is, India, which 7 or 8 weeks ago was also rated at number one, or at the low end of the entire database, is now pulled back up into the green. So there's some evidence there of sector cycling going on. Inside the U.S., you can see that the mid caps and small caps are above average, with large caps suffering. Technology has been suffering, although later in this past week we did see some gains starting to flow back into the U.S. tech. If we take a look at the ETF top 30, we're going to see it dominated once more by silver, precious metals, anything that's in the energy sector, and then any commodities. We still have grains in the top 30. ETF liquidity. You can see that the VIX is almost at 6.5% of intraday volatility. Japan remains extremely volatile, followed by oil services, silver, and metals and mining. And that's a review of the weekly report. This is Ken Long from Tortoise Capital. Keep your powder dry and your risk managed.